The stock market surged 400 points on Tuesday because Trump suggested he might end the Iran war without reopening the Strait of Hormuz. Gas prices topped $4 a gallon the same morning. Those two facts should not coexist, and Wall Street noted the contradiction almost immediately. A Dow that rallies on war-ending signals while crude stays above $100 a barrel is pricing in relief that may not arrive. The Strait of Hormuz carries roughly 1/5 of the world's daily oil supply. If Iran retains control of that corridor after U.S. forces withdraw, energy markets would face a structural constraint, not a temporary spike. Trump wrote on social media that other nations should just take the strait themselves. Market analysts at Signum Global called that scenario extremely unlikely for 3 reasons: damage to the U.S. economy, harm to Gulf allies, and the comparative global disadvantage of leaving Iran as the gatekeeper of global oil flow. Jamie Dimon went on Finish. JPMorgan CEO said the U.S. must complete the mission to protect the global economy, not just end the shooting. Wolf Research noted that Trump has shown clear signs of wanting to exit the war for 2 weeks, but that a hasty withdrawal without a demonstrated ability to reopen the strait remains politically untenable. The rally, in other words, may be pricing in an outcome that the White House itself has not yet decided. That same oil shock bleeding through gas pumps is now colliding with a labor market that was already stalling before the war began. The Bureau of Labor Statistics reported Tuesday that the U.S. hiring rate fell to 3.1% in February, the lowest since April 2020 when the economy was physically closed. Job openings dropped to 6.9 million, down 358,000 from January. The quits rate held at 1.9%, layoffs stayed at 1.1%, and retirement slowed. Everyone is frozen in place. Chief economist Heather Long at Navy Federal called it a brutal job market. The comparison to 2020 is exact. Back then, businesses were shuttered by law. Today, they are open, but still barely hiring. Skanla Amarnoth of Employ America estimated that weather and healthcare strikes explain 50 to 60% of the February drop, leaving a real, unexplained residual. Reduced immigration has removed a layer of churn from the system. Fewer new workers means fewer job switches, fewer hires, less dynamism. The JOLTS data predates the Iran war entirely. With Brent crude above 115 and the strait effectively closed, ZipRecruiter's labor economist warned that surging fuel costs would hit transportation, manufacturing, retail, and consumer spending, pulling back hiring further in the March data. Wells Fargo CEO Charlie Scharf acknowledged a fragility in markets while insisting the underlying economy remains strong. Consumers are still spending, he said, even 20 to 30% more on fuel, but he added a conditional, depending on how long the war goes on. That qualifier is now the load-bearing question for every economic projection. The March jobs report lands Friday. If it confirms February's freeze, the Fed's policy calculus shifts significantly, inflation already running a full percentage point above target, with growth now potentially softening.
The thread connecting both stories is the same variable: the duration of the war and what ends it. If Trump exits without the strait, oil markets face a structural ceiling. Not a ceiling that breaks with a peace announcement, but one that persists for months as a new geopolitical equilibrium forms. The labor market, already at COVID-era hiring lows before a single war-related layoff, would absorb that energy shock through reduced consumer spending and tighter corporate margins. The hiring freeze that economists are currently attributing to weather and immigration could deepen into something harder to reverse. The weight of evidence at this moment points toward a prolonged energy premium even after a ceasefire, because the physical bottleneck at the strait is not resolved by diplomacy alone. Chevron's analysts estimate every $1 move in Brent crude adds $600 million to annual earnings, which is useful context for understanding why energy stocks are the one sector not signaling alarm. But that premium tuts in the other direction for airlines, manufacturers, and retailers. JetBlue raised bag fees Tuesday. The clean energy sector, up 77% over the past year, is pricing in an extended period of high fossil fuel costs as a structural driver, not a temporary geopolitical premium. The leaning here is that the war ends, but not cleanly. A ceasefire without a verified reopening of the Strait of Hormuz would leave markets in an ambiguous zone, where equities rally on headline relief, but energy prices remain elevated. The scenario that reverses this view is a rapid, verifiable U.S.-brokered reopening of the strait, paired with a strong March jobs print on Friday. Friday's jobs number is the first benchmark. The second is whether Trump's public statements on the strait converge or diverge further from what the WSJ reports his aides are hearing privately. If those two signals split further apart, the Tuesday rally may prove to be one of the most expensive misreadings of the week.